debt is rising while real estate values are declining. I wanted to share these with you. These are hot off the press. I just printed these out right before I walked in here. Now, these are not nationwide. These are just in my local market segment, which is the Spokane, Washington, which is Eastern Washington. If you know where Seattle is on a map, Eastern Washington, Spokane is just about 5 hours east of Seattle. And then we are also in the Coeur d'Alene, Idaho demographic, which is about 100 miles south of the Canadian border. So these two markets make up what we call the Spokane Coeur d'Alene market, roughly a population of about 900,000 people. But in our market, I've got two things. I've got the year-over-year stats, and I have the month-to-month stats. Now, month-to-month closed sales are down 20%. From last month to this month, down 20%. New listings are down 26%. Active inventory is down 19%. And days on market is up 43.3%. Now, that's just in 30 days. But let's look at what's happened in the last 12 months. It gets even more painful. Year over year, from last year to this year, we have seen 44% fewer transactions closed. We have seen 12.6% less active listings. We have seen median days on market, which a year ago were 22. They have gone up 168%. Now, 168%, 22, that's going to put us roughly at almost 75 to 80 days on market, 168% increase. And we've seen active inventory go up 99.8%, 100% increase in active inventory with a reduction in closed volume by 44%. So we have 100% more inventory that we had a year ago and half the closings. Now, I want you to think about that. How many real estate agents did we need a year ago versus how many real estate agents do we have now? A year ago, interest rates were hovering right around 3.25%. Today, as of right now, interest rates are at 7.08% with another meeting of the Federal Reserve happening on December 14th. Just a few days from right now, we could see another 0.75 point increase, which would take rates to almost 8% interest. Now, if the real estate market wasn't already slow, another 0.75 point increase is going to make it even worse. Now, there was some early chatter that the Feds might pull back. So instead of a 0.75 point raise, maybe a 0.5 point, maybe even a 0.25 point raise was some of the early discussion. Now, this was before we got the sales results from Black Friday, the Friday after Thanksgiving, and even worse when they got the sales results for Cyber Monday, both days being record spending online. Black Friday, almost $18 billion, and Cyber Monday, $28 billion in online sales. So the Feds are looking at this and going, okay, clearly Americans aren't being affected by the inflation at 9%. It has come down to about 7.8 as a result of the rising rates. The cost of fuel still being extra high, cost of energy being higher than it's ever been, and yet we have record spending. And so the Feds are looking at this going, okay, well, maybe, people aren't thinking recession. Maybe people aren't cooling down on their spending, but yet they failed to look at the fact that debt on credit cards is going up exponentially. We see the recession, we see the rising cost of fuel, we see the increase in cost of capital, and yet we just put it on credit cards. So debt is rising while real estate values are declining and home equity is reducing. And even if you wanted to tap into your home equity, the cost of getting it out through a home equity line of credit is going to run you almost 8% interest. Doesn't make any sense. But for those of us who know how to read the tea leaves and how to maneuver through all of these things, I can tell you this, it's going to be a very interesting and profitable real estate market in 2023 for those who follow our lead and do what we tell you to do.